Welcome back to Liquid Lunch. There's a little Jimmy Riggers from their brand new album.
Does he have riggers? Okay, anyways. Good, thank you.
It's a rigorous attention to detail that they do on the music creation project.
All right.
We've got Joe the Investor here now. Joe, great to have you here as always today.
Yes, how are you?
I am good, thank you. Now, we're going to talk about hyperinflation today.
Yes.
Right?
Yes.
Because we do not want hyperinflation, do we?
No, we don't.
Okay. Some people are talking about, of course, the classic examples that in economics classes, the Weimar Republic in Germany, where the people with their wheelbarrows full of money going and buying loaves of bread and stuff like that. Of course, we've had the recent hyperinflation in Zimbabwe.
Yeah.
In fact, somebody brought a $10 trillion note from Zimbabwe.
Yeah,
I think it had a picture of Robert Mugabe on it.
Yeah, I have one at home, actually.
Do you?
It got to $100 trillion reserve note.
Yeah, I'd love to. That's great that you got one. I'd love to have one too.
From the coin dealers, you can get one if you really want one.
Really? There's probably lots of them out there. Right. But and people are talking about that now with what's happening with the U.S. economy since the bailouts, since the war, of course, because they're spending billions and billions of dollars on that war, and they're not keeping up with the tax, in income. That, and now with the quantitative easing, which is what they're doing to whatever the Fed is doing, that there's a real some people are talking about there's a real possibility that the U.S. anyway may slip into a hyperinflation mode. What do you think?
It's possible. These events are not probable, but it can always happen. How I look at it is, for currency, there's a faith in the currency. It used to be backed by physical goods, but after the gold standard, it's been backed by basically people understanding that if I give you a $20 bill, it'll be honored. And in this case, if it's the government giving you the money, because they print all the money, that money is backed by something. And when there's a hyperinflation scenario, people don't believe that anymore. They think that the money isn't backed by anything and it's not worth anything, so people won't accept it any longer. And so if you can just imagine trying to buy something and they don't take your money and take that across the country, that's basically what happens. And that's at the extreme. And so for Zimbabwe, which is recent, that happened there, so they just printed more and more money, so the numbers got bigger and bigger. Eventually nobody took the money, so they said, we'll use the US dollar instead, because that's a well-known currency and it's relatively stable versus the Zimbabwe dollar. So they did that and the issue went away.
Really? Is that what they've done in Zimbabwe now?
That's what they did after that episode.
They switched to the US dollar?
And so they got the people's faith back into the money, so it was accepted as it is normally. So if that I think is the trigger between a regular economy and a hyperinflation. If people lose faith in the money, that's what would happen. The normal inflation that you hear about every day, that I think is different. It's when you print money, you have to have goods to back it up. So everything that's bought and sold is exchanged. There's money representing that, and that's what all the money is for. If there's a little bit too much money, there's a little bit of inflation. If there's a little bit less money, there's a little bit of deflation. But when it gets to the extreme, and then you get to hyperinflation, but there's that psychological trigger that comes with it, where people say, gee, you're printing $100 trillion. What's behind this? Can I really trust it? And when that idea comes up, that's where the risk comes in.
Right. Well, it's kind of an intriguing discussion, because even very recently, economists were saying that there was even a danger of, because inflation really has been quite low since Ronald Reagan, Margaret Thatcher, and I think Mulroney all raised the interest rates. It was the Austrian school, I think. Whatever. Anyway, those new economists, Milton Friedman, and the gang came in to they replaced the Keynesians in 1980, and they said we're going to squeeze inflation out of the economy. They raised the interest rates to very high levels, destroyed real estate market, but they did get inflation under control with that one tool, interest rates, and there was even some talk a couple of years ago, even now, that we're in a danger of slipping into deflation, which would be, I really think, quite disastrous if we were to have a deflation. But so now people are still talking a little bit about the possibility of deflation. The U.S. interest rate is almost zero, isn't it? And
yeah.
And they're trying to keep it low to pump up the economy a little bit, to free up money to be used in the economy. But on the other hand, people are starting to talk about the risk of hyperinflation with all the new money that's been created to bail out the banks, to pay for the war, and to do whatever else they're doing down there.
Are you making a statement or a question?
Yes.
Well, I have a question. Years ago, banks were offering a high interest rate if you put your money there.
Yeah.
12%, 13%. In the late 1980s, in the early 1990s. And now you're lucky if you get 1.5.
Yeah.
Is it ever going to go back up to that 12%?
Oh, it can.
Do you think it's ever going to happen? I've asked this question before.
I think it will, yeah. The timing...
It's been 20 years.
But if it does that, I mean, if it goes up to 12%, doesn't that mean that inflation is going to be at least 10% or something like that, Joe?
That's what I would think, yeah.
Yeah. So
You're
it's not
so
necessarily good news.
Well,
Marla.
yeah, but the thing is, if you have a lot of savings in the bank, I used to live off my interest.
No, I used to think about that too. I used to think if I win $100,000,
Yeah.
I can live on $7,000 a year when
Yeah.
interest rates are 7%.
Well, when it was 12, it was incredible.
Yeah.
Yeah.
But that's an interesting point. The higher those interest rates are that the banks are paying on deposits, the more people have an incentive to save money,
Yeah.
right? And they're saying our
that's true.
savings rates have been falling
Very,
and falling
very
and falling.
low.
Well, why do you think? Because we're not getting any money for it in the bank, right? But we put it into the stock market, we put it into the real estate market, we put it into other.
Well,
other
it's a gamble.
things.
And if they did offer higher interest rates, people would keep their money in the bank, and it would be win-win.
But
And
here's the problem,
Banks
if
would
we-
have the money to invest for themselves.
I read a thing recently, Joe, that it's, so inflation is one thing, but somebody's saying hyperinflation is not just more inflation. Hyperinflation is a different animal than inflation.
Well, that's what I say, yeah.
Yeah.
The difference is that the trust is lost in the money.
Well, I mean, inflation
And
means there's
it's-
some
and it's a-
erosion of the trust, right? But
Well, you could say that inflation in the short term, so say the economy is completely balanced, there's so many dollars and there's so many goods and there's no inflation, they could a year later print a little bit more money, so there's a little bit of inflation, 1%, 2%. Then the economy starts to produce more things and it gets back to where it was and it's zero again. So you could have that happen over 1 or 2 years, 3 years. Hyperinflation's different in that everything's lost. Currency could go down 90%,
All right, so-
95%.
okay.
And that's why, and that's basically like the Zimbabwe example, $100 trillion was used for buying a small item. It wasn't used as a bailout. So they can make the numbers as big as they want.
Yeah.
People just said, well, there's a piece of paper with a number on it.
Mm-hmm.
So what?
Mm-hmm.
And that's why I say it's different.
Okay. So how would it happen? Let's talk a little bit about what would happen to take us from this situation now where prices are relatively stable, Although people are talking about, hidden inflation and food prices going up and stuff like that. But what would the mechanism be by which hyperinflation might take hold of the economy? Like, would there be a...
Well, I'll give you one scenario. Say they continue to print the money that they're printing.
But are they printing it? I mean, I know the banks have gotten bailed out, but are they actually like printing money? And because the people on the street aren't getting any of this money, right?
Well, yeah, that's debated as well. I don't think they are either entirely. What they typically do when they print money is they make loans, they make debt, and the banks, all the banks together make these loans available. So what they've done in the past, and I think they still do it to an extent, the economy was controlled by loans. So when those rates were really, really high, there wasn't as much money being made available. So you'd have to fight for the money, basically. So if you only have $1 million to lend, and customers came in and said, well, I need $2 million to borrow, I only have $1 million in my bank, so I'll keep raising the price until whatever number of people equals $1 million, and then I'll give the loans out. Now they've done the opposite, where there's so much money that, and nobody wants to borrow it, so the rates went right down to zero, and it's still not doing anything yet. So to get to that scenario of hyperinflation, if people start buying all sorts of things, then the prices will go up very, very quickly. The banks will look at that and say, well, the prices are going up very quickly, so I can afford to lend at a higher rate because there's more people looking for money. Mm-hmm. And that would raise the interest rate. Now, if this got to the extreme where prices went up so quickly, then you'd have a hyperinflation scenario and the rates would go up very quickly to try to rebalance. Mm-hmm. In a hyperinflation scenario, you wouldn't rebalance it that easily. It would be so fast that it'd be so fast that they couldn't control it, basically.
Yeah.
Is there any safety in blue chip stocks? At one time, that was considered a very secure thing. Blue chip can't go wrong. They always stay high, blah, blah, blah. And then I just had a meeting with a financial person, and they said, oh, even they went down. There's no security in that either. What's secure?
Well, the honest truth is nothing is secure. It's all a matter of how much. I mean, blue chips are safer than every other stock,
right.
Say.
In comparison to others, they're more safe than other things. GICs are more safe than other things.
And they're more safe than most things.
Canadian government bonds are more safe than, et cetera, et cetera, et cetera. But stocks are the highest risk. Is that correct?
Well, there's even
mutual funds.
There's even something higher risk than that.
What is that?
Like futures, for example.
Sorry?
Or like buying commodity futures.
Okay.
Or using a lot of debt to buy a stock would be a lot more risk than buying it with cash.
Okay.
That's another way to... And even real estate, depending where you buy it, could be very high risk. If it's a country that's not stable or an area that's...
Well, and we don't know the risks. We don't. That's the thing about risk.
Well,
you
if
don't
people
know what
could
the risk
predict,
is.
and when people become investors and advisors, I always ask them, how rich are you? Because if you're rich, I can trust you with my money. But if you're not, I can't trust you. Because if you really can foresee the future financially or know what to advise, then you would have more money in the bank for yourself. Is that a great...
That's basically true.
Yeah,
I mean, nobody knows what's going to happen completely. People are better at it than others. So I look at their track record.
Right.
If you make calls, how accurate are you? How many have you got right? How many have you got wrong? If you put your own money into something and you're saying, buy this, I have some. Now, there's two sides to that. If they have money in it and they're telling you to buy it, they might be telling you to buy it so they can sell it. or they might be saying it because they really believe in it. So
I see.
that you kind of have to
That's a good point.
ask
Yeah.
more questions to them as to why did you buy it and why do you believe in it. And
You know what I say
that-
when someone asks me to invest in something? I say, okay, and they say, well, I have my own money, and I said, does your mama? Does your mother have? Did you let your mother put money in that? And when they say yeah, I went, okay, fine. I'll give you some of my money. But if they don't even, it always comes back to the mother.
well, it's an issue of trust. If you can trust
Yeah, because
them,
if you're a kind of person who would hurt your mother, then don't give them your money.
Right.
Yeah. So.
Maybe they're trying to hurt their mother. That's why they got
Well,
their mother
that's it,
to
and you have
invest in
to
the
find
company.
out. Then you have to
don't
find
know.
out their
They're
childhood.
trying to hurt their mother, and
Yeah.
you're putting money into this company?
Yeah. Then we're really screwed.
Joe, what do you think? Okay, here's a scenario I heard for hyperinflation, and I'm not sure I understand if I'm getting everything right here. But now, what is it when the U.S. Treasury needs money, i.e., the government needs money to pay for the war, pay for the Social Security, pay for the roads, and all that stuff? What do? They go to the Federal Reserve,
yeah,
that private bank owned by the Rockefellers and those other people. And they go to the Federal Reserve and they say, we need money, right? Is that how it works?
basically, yeah.
And the Federal Reserve either prints the money or just creates the money in an account, gives it to the Treasury, right? What are these Treasury bonds or Treasury bills?
Well, they're bonds. They're basically debt. So
Debt that who owes to who?
the government would owe the Federal Reserve,
Okay, those are the Treasury bonds. So,
and that's all the bonds.
Right.
Bonds are all debt
okay.
paid by the government to the Federal Reserve or whoever issued.
And who's
The
buying
debt.
these certificates, these Treasury certificates? The marketplace in general?
They typically go to a bond market and they auction them off. So
To the market.
and
the market
typically
in
the
general.
banks buy these
Banks,
other
okay.
banks.
So the scenario I heard is that at some point, if these banks start to lose faith, again, it's the faith in the money. If they lose faith that that they're not going to get repaid, or that there's going to be a panic, or that the U.S. has lost its solvency, or that they just owe too much money for whatever reason, they no longer have faith in these Treasury certificates, then they're going to start to buy, instead of buying the Treasury, they're going to buy other stuff. They're going to buy commodities. They're going to buy other things. And when they stop buying those Treasury certificates, then
The rates would go up.
that's when the hyperinflation might kick in.
Well, that's one way to do it. So whenever the government wants to create more debt, so they go through the reserve, they make these bonds, they auction them to banks, and basically it's like an auction sale.
Mm-hmm.
They have a tender and they say, I have $1 billion of debt, who wants it?
Yeah.
And each bank puts in how much they want in dollars,
Yeah.
and what rate they want to pay, so it's an interest rate.
Right.
And that's the payment, because you
Right.
get interest back for the money you're...
Yeah. So what happens when they
lending.
lose faith? Then the government has to start to offer more
More.
interest, higher interest rates, and that's what's going to cause. That's what's going to kick in the inflationary spiral.
If it gets to an extreme where they say they give 1% more and nobody wants them, they'll give 2% more and nobody wants them, they'll give 10%, nobody wants them.
Yeah.
Now what you've said is the rates went up 10% in a few minutes.
Yeah.
And then if that hits the retail market, your bank will raise the rate 10% for that term of bond. So if it's a 5-year bond, it'd be a 5-year investment.
Mm-hmm.
The mortgage is derived closely to that, not exactly, but they all follow each other, all the different rates.
Mm-hmm.
And so that's possible. And then the people who refuse to buy would say, well, this country has a better record of paying than you do, so
Right.
I'll buy theirs.
Mm-hmm. Or people just start to put their money into the hard assets. Actually, I was out last night and somebody was telling me that people are even starting to take, like people who have a lot of money, they're starting to take their money and buy what they're calling hard assets. And even things like fine art, like what they were calling blue chip Canadian painters like some of the big
Group of 7.
Well, group of 7, they're almost beyond blue chip, but you know, people like well-known Canadian artists, people that have been acknowledged. I won't name any names here, but
No,
you
that's
know,
probably because you can't. No, you know.
Yeah, you're
it's,
just saying that.
No, it's that thing
like
about
the Painters
Canada.
11.
The UNOs.
No, there's
the Who Know
there's
Awards.
a Painters 11, that the abstract expressionist
Okay.
movement. They're like the equivalent of the group of 7, but abstract expressionism,
Okay.
starting in the 50s.
Okay.
I don't want to name any names. I don't want to favor any of them.
Okay. Good
Okay,
for
but
you.
anyways, he was saying a lot of these people are starting to buy these paintings now. They at least want something tangible to hold, because the blue chip art has continued to produce really good returns. So that might be a reflection in general, that people are really wanting to have something solid in their hands with their money, some real solid tangible assets.
I think that's partially why gold is up where it is and why silver is up where it is. These are currency substitutes.
Right.
And that's a lot of the reason why they
Are so high.
have done what they've done the last 5 years.
What do you think the chances are, Joe, that we're going to see some serious inflation in the U.S. and or Canada and or the world? What do you think?
Well, the chances aren't that great, to be honest. However, if it happens quickly, so it's something to keep in mind. Because these scenarios we talked about would all happen in a short time, in a few months, a few weeks,
Yeah.
within a year. If suddenly someone stopped buying treasury bonds, and at any price nobody would buy them, that would happen instantly.
Mm-hmm.
And so what I would look for is the signals that things are moving very quickly. The prices start to go up in the stores quickly.
Mm-hmm. And you think it's unlikely?
I think it's unlikely. I mean, I'm hedging against it with my money in case of, but if I had to put a percentage on it, it would probably be less than 10%. However...
Why do you say that, though? I mean, why do you say it's unlikely?
Well, a lot of things have to happen for that a result, because it's an extreme result.
Yeah.
So they have to print a lot of money, people have to lose faith in it, has to be at the same time. People buying bonds would say, I don't want them. And it would all have to be coordinated. If any one of those things didn't happen, so say there's a lot of money printed, but people didn't lose faith in it, we could go on another 20, 30 years in this state.
Do you think there's a real willingness on the part of the people that are making the decisions, the policymakers, to make sure that that we keep things on a stable track, or is there a conspiracy to like totally pull the rug out from under the U.S. economy, like some of the conspiracy theorists are saying?
Yeah, that's a tough one to answer. You never know. It's probably a bit of both, because every crisis is an opportunity. So if that does happen, if someone's piling up gold, they'll make a lot of money. If someone's piling up that art that you're talking about, and they sell it right at the perfect time to sell it, and they get $1 billion for a piece of art, they don't mind if this happens. So there's probably somebody hoping it'll happen, and there's people who hope it doesn't happen.
Interesting. Very interesting. These are interesting times. Are
Scary
they not, Marla?
times. Scary, scary times.
Yeah.
I'm scared.
Are you scared?
I am.
Really?
Yeah.
Oh, well, that's too bad. Okay.
You're so empathetic.
All right. Well, listen, Joe, thanks for coming in. That's it for Liquid Lunch today. But we should tell people how to get in touch with you and why they should do that.
Well, okay, well, I'll tell you how first.
Yeah.
My website is www.joetheinvestor.ca. And I'm on Twitter as well, but it's more for, I put quotes on there, @JoeTheInvestor. And my email is joetheinvestor.today@gmail.com. And why? My whole philosophy is, if you're looking to really understand what's happening in the money system, the economy, you want to hear something different than what the bank's telling you, and learn how to do your own research, then I'm the person to talk to.
All right. Great. So joeltheinvestor.ca, people can get and stay in touch with you there. Thanks again. Always an interesting discussion. And kind of reassuring today, Marla, despite the fact that you're scared, Joe's telling us there's less than a 10% chance of a hyperinflation.
Okay.
So there you go. All right. Joe, thanks.
Okay,
Thanks, Marla.
Thank you, Hugh.